I want to talk briefly about what an income statement is. Companies obviously make revenues or have sales, which is money that comes into the company, and then they have numerous expenses which they have to pay, and whatever's left over after all of those expenses is the profit. Now that makes a lot of sense, but obviously there's a format in which this information has to be captured, and there has to be a manner in which we can communicate and talk about how that happens within a company. So the way that we capture the information that relates to how a company is doing in sales, expenses, costs, and profit is through the income statement. The income statement is a statement that captures those money flows over a period of time, for example, a year or a quarter, or perhaps in very rare cases, a month. But typically it's provided in an annual report at the end of the year, certainly for a company, and it will show that how over that year, what were the revenues of the company? What did it actually generate in terms of sales? Revenue, sales, same thing. And what were the expenses? And what was then left as net profit? We can see this in the following exhibit. The way that these income statements are typically structured is that they go from revenues, which are obviously very related to the business, and then they subtract expenses that are the first expenses that are subtracted are the ones that are most related to the business. So the first expense that's subtracted is cost of goods sold, leaving us with some idea of how the company is done after we just take away from the revenues the cost of the goods. Then we take away operating expenses, and then we can see how the company did after its cost of goods sold and after operating expenses. And then as we travel down the income statement, the expenses that are subtracted are less and less related to the actual business. So as we get closer to the bottom, we have the interest expense, which is really particular to the company and how it's funded, not so much a reflection of how the business is actually doing. And lastly, taxes, which is really more a reflection of tax policy and the government tax rate and which tax bracket this company falls into, as opposed to being a reflection of how the company is doing. So an income statement captures the flows of a company, the revenues, the expenses, and ultimately the profits of a business over a certain period of time, for example a year, going from those most related to the business to those least related to the business. It's an accounting statement, and therefore it doesn't necessarily reflect exact cash flows because it reflects when things were billed. It also has things like depreciation in it, but it's an accounting statement that reflects the operating environment of a company from revenues or sales down to profits.